Hello friends, welcome to my channel, A Voyage into Crypto Metaverse. This is chapter 10. Today we are going to talk about margin trading. But before I get started, a little disclaimer. None of this is financial advice. It is only for fun, entertainment, and education. So with that, let's get started. So in my previous video, I actually showed you how to buy Bitcoin on the spot market. So the margin trading is a little different from spot market. The difference basically is the leverage. So basically we use leverage here, which means that you increase your buying power. You borrow money from the exchange and you can buy more. So how that works, I'm going to show you. So the basic concept is that you have a collateral. So you have your deposit, for example, say you have $100. So but with the 10x leverage, your buying power becomes $1,000 rather than $100. So you increase your buying power and also your profits. So how does that work? For example, I'll give you another example. So say Bitcoin price is $20,000 and you want to buy one full Bitcoin. So you pay $20,000 on the spot market and you buy one full Bitcoin. So, and say the Bitcoin price goes up by 10%. So now the Bitcoin price is $22,000 and you can cash out. So your profit is $2,000 now. But if you use leverage, if you say you have $20,000, but you can buy, you can use 10x leverage and you can buy 10 Bitcoins rather than just one Bitcoin. And the price say goes up 10%. So now the price is $22,000. So rather than your profit just being $2,000, it is now $20,000. So you sell Bitcoin in that case, and then you return the borrowed money to the exchange, and then you get your profit and your deposit back. So this is how it works at a high level, but it's another word of caution. It's not for the new traders like us. It's for the experienced pro traders who know their technical analysis and who know their risk management and all. And they, so mostly when the new traders start trading, they mostly go in loss because of various reasons. I'll talk about that. But it's actually a two-edged sword. So it can generate great profits, but at the same time, it can also make great losses also if the market goes against you. So let's keep going. So now again, so sometimes you may hear that someone took a long position or a short position. So what does that mean? So long position means that you are expecting the market to go up and you profit if the market goes up. For example, in that previous example that I gave, so you buy Bitcoin at $20,000. You are when you buy, you are actually kind of long. You are holding a long position, and then Bitcoin goes up 10%. So you are in profit. So that is the long position. So short position means selling. So you expect the market to go down, so you can sell. But the difference between spot market and the margin trading or the this market is that you can actually sell even if you don't hold. So even if you don't have Bitcoin, you can still sell Bitcoin. You can short Bitcoin in that case. So what next? What is a stop loss? So stop loss basically you open a position and you expect the market to go in a certain direction. But if the market goes in the opposite direction, you want to cut your loss. You don't want to keep holding that position because your idea is kind of invalidated. So you don't want to hold on to that position, and you want to cut it short, and you want to uh, bail out of the trade. So that is the stop loss. And basically there you incur some loss, but still you don't go keep going into losses. So one reason why new traders like us, they actually get they go into huge losses because they don't put a stop loss. They think that okay, they can take that loss, but then they think that the market may again reverse and go in their direction, but then it keeps going in the same direction, and you are not able to cut. And also it's a kind of a risk management strategy where you before even you start your trade, before you even you open your position, you already you think about it, and then you already know where is your stop loss, where is your take profit, and all that. So if you don't think about that, then it's a very risky trade, and you can actually lose all of your collateral or your deposit, and you can go into a loss. So next. So again, so I already talked about going into loss, and uh, so this happens when, so when you open a position, you have a liquidation price, which means that if the market is not going, if the market is not going in your direction, it goes in the reverse direction. So you have at what price the exchange will try to liquidate your position or close your position and try to recover their the money that they gave you for the trading. So that is the liquidation price. So I'll show you also in a demo. So what is a margin call? Basically, when the trade goes in the opposite direction and your collateral is so small that it cannot cover the interest that you incur on the money that you borrow from the exchange, so you can get a margin call. And margin call is not a good sign. So if you get a margin call, means you didn't put a stop loss, and then the trade goes against you. And finally, if you so there are two options there. So either you can do nothing about your margin call, or you can add more collateral. So for example, you deposited $100 and then you borrowed $900 and you're trading with $1,000. But now your trade is going in the opposite direction, and you get a margin call. So what you can do here, you can add more collateral. You can add another $100, and now your leverage is only 5x rather than 10x in that case. So you are saved. Your liquidation price will move further away, and then you can have some more time to think about it and maybe close your trade and all that. And if nothing else works out, and the trade is just going in the opposite direction, and ultimately the exchange will try to get its money back, and it will liquidate your position at the current market price. So that is what the liquidation is. So next, another important factor is how you want to trade. So there are two types of trading, either the isolated margin or the cross margin. So isolated margin means you are only trading with one pair, and you have, for example, you are having Bitcoin and you have, say, USD. So you are trading in that pair, and you are isolating with only, so only Bitcoin will be used as your collateral and not other coins. But cross margin, you can, if you have, you are holding coins on the exchange, so all of your coins can be used for that cross margin. So it can be helpful. You don't want to, for example, you, even if you have only $100 worth of Bitcoin, so you can you can only trade with $100 in that case. But with cross margin, you can, if you have other coins on the exchange, your deposit increases. But in, again, it's again another risk factor is that in cross margin, if in case of the trade goes in the opposite direction, and all of your coins could be liquidated, could be sold to cover up the the money that you borrowed from the exchange. So that is about it. So I can now show you a quick demo. Let me switch screens. I have logged into my Binance account, and so first of all, actually, we need to go into our margin wallet and deposit some funds there. So I'll go into a margin account, and so here you see cross and isolated. So I want to just trade isolated, not cross. So here you see I can trade in these various markets. So I want to trade, say, for example, I want to trade in BTC and USDT. So what I'm going to do is transfer some money, or my Bitcoin that I bought in the last video. So this one, I say, okay, isolated, sorry about that, BTC USDT, and then I select Bitcoin, I say max, and then confirm. So actually I'm transferring my Bitcoin from the spot trading, from the spot market into isolated wallet, isolated margin trading wallet. So I have now some balance here. So if I go now to trade, so in the last video I showed you the spot market. So this time we are going to go to the margin trading market. So here it's selected cross. So let's go to the isolated because I transferred the money there. So here you can see that I have this, so my position BTC 0032 and position USDT I have 0. So, but if I want to buy, say if I want to open a long position, so what I can do is I can go into this borrow option, and then I can see, so here you see available 601. So I had some $60 60 US dollar worth of Bitcoin. So I can go up to 10x, so which is like $600. So I can borrow up to $600 of USDT, and here I can buy, say I want to buy this 0.01 Bitcoin, or if I want to go to max, I can use all 10x, but I generally don't use all 10x because if I use all of my full leverage, if I margin buy at full leverage, then what happens is that it will my liquidation price will be very close. So as soon as the market starts going down, I can I may get liquidated. So I don't want to do that. I generally if I want to do, I generally go max 5x most of the time. So I'll show you maybe $300 up to $300 I can buy. Maybe just go to market buy rather than, so I want to spend $300. So margin by BTC. So it's saying I'm going to borrow and it will incur interest. So I say, okay, confirm. So my market buy order is filled. Here I am. So this is my trade history. So I have bought Bitcoin. So it is actually showing multiple trades because I market bought and it executed in multiple orders. So it is showing all these various orders, but I need to go into position. If you see my position, so I have 0.0176 and I have used, I have borrowed $299. So this is my position. So index price, yeah. So index price is $20,890, which is the current price. And then, but my bought price was lower than that, and it quickly moved up. And then you can see the liquidation price is this 17,915. So if the price goes to this price, so my position will be liquidated, and the exchange will recover its funds, and the position liquidation price is actually 14% below this current price. So if I use 10x, it will be much closer, and I will be liquidated very quickly. So I see the market is moved up like $100 or maybe $50 from where I bought at. So I may want to close my position. So what I can do is I can go to sell and go to repay. And so I'll just select the sell option and then the repay option. So it will automatically repay the debt that I have, and also it will sell the Bitcoin that I bought on margin and then recover the money. So the price I need to put maybe 895 or $900, or I can say market also. But let me just do limit, because yeah, I'll just do limit, sell BTC, confirm, repaying $300. So my order is actually executed and I have paid it back. So now if I look at my position, so if I look at my position, so you can see that I have $4 profit or something, and my position value is this much. I am in green now because I have prepaid my loan, and I have closed that position, so I'm no longer holding that position. So I can actually move the Bitcoin out of the margin account and move it back into my spot wallet. So if I go into margin wallet, isolated margin, so I'll just transfer it back into my from my isolated margin account to my spot account. BTC, USDT. Yeah, so this is that was the demo of how to trade on Binance using margin trading. It is a bit confusing when you get started, but you'll get a hang of it when you go on. So that is about it. So I'll just thanks for watching. This is a very nice tweet from John Brown. So a trade is like riding the bus. You should know before where to get off. So that means that where to take profit and where to stop loss. So if you take the wrong bus, you get out quickly. So if your idea gets invalidated, if your trade goes in the wrong direction, so you cut that trade, so you stop loss and you just bail out. So if it is too crowded, let it pass and take the next one. So there are a lot of opportunities. The market keeps moving all day. So you don't need to feel bad. So you just wait for the next trade. So let the trade come to you rather than you go to the trade. So thanks for watching, guys. Bye for now.